You've seen it everywhere, right? Artificial intelligence has absolutely exploded into the stock market. We're talking a staggering $25 trillion flooding into the sector. It really feels like the ultimate golden ticket. But what if it's also a trap? To really get a handle on the risks that might be hiding in plain sight today, we're going to take a little trip into a possible future, sort of a thought experiment to uncover the warning signs we might be missing right now.
So, I want you to picture this. The year is 2026. It's February. The market's just humming along, you know? Investors are feeling good, and AI seems like this unstoppable money-making machine. But then, something just snaps.
Practically overnight, whole sectors just collapse. Programming, financial services, fintech, they all take a nosedive. The very tools that were supposed to be this huge revolution suddenly became what one analysis called a graveyard for capital. A shocking, sudden crash that seemingly came out of nowhere.
So how could something like that even happen? Was it really just a bolt from the blue? Or were there warning signs that, maybe everyone just chose to ignore?
Well, that's exactly what we're going to dig into. We're going to rewind from this hypothetical future crash and start piecing together the clues, all the evidence that was hiding in plain sight the whole time.
Okay, so our first warning sign. It all starts with something we're all pretty familiar with: hype. A massive bubble of just pure optimism and these wildly overvalued expectations that were basically setting the stage for a total disaster. And this slide right here shows this huge disconnect. You had investment banks dreaming of this 1.7% productivity boom thanks to AI, but the reality, what the S&P 500 was actually showing, barely 0.6%. And that dangerous gap between the hype and the reality, well, that's where your profits start to disappear.
And just look at what that hype did. Tech giants were trading at a price-to-earnings ratio of 28. To justify a number like that, they'd have to deliver these incredible, almost impossible results. Investors weren't buying the company's reality, they were buying the dream.
All right, let's move on to our second clue, and you'll see how this all builds. We'll call this one the reality gap. It's all about that massive difference between what the market was guessing and how slowly companies were actually bringing AI on board.
I mean, just look at this. While the stock market was pricing things in for rocket ship growth, the actual data from 2025 showed that less than 10% of companies had really adopted AI into their main operations. The market was hitting the accelerator, but the real-world foundation wasn't even built yet.
Now for our third warning sign. And this is where things get genuinely alarming. We're moving away from what the market thought was happening and looking at how the AI trading models themselves were actually performing. And believe me, the results are not what you'd think.
So a big study in 2025 tested 6 of the top AI trading models, and the results were just shocking. You can see it right here on this slide. Only 1 of the 6 actually made any money. The other 5 lost money, and some of them lost almost half of the starting cash. The very tools people were putting all their trust into were most of the time actively working against them.
And that really brings us to a crucial point, doesn't it? These things aren't magic crystal balls, they're tools. They're built by humans, and they come with all the same potential for mistakes and biases that we do. It is not a magic wand for your portfolio.
Which leads us right into our fourth and final clue, a specific metric that was created to try and measure the risk of just blindly trusting these AI models. It's called the Danger Index.
But before we even define what it is, just look at this number. A 2025 study found an 8% loss rate for investors that was directly because of their blind trust in faulty data that AI gave them. Bots were feeding people data on companies that didn't even exist, or passing off info that was weeks old and pretending it was real time.
So what is this Danger Index? Well, it's a score that measures exactly that risk. It looks at how accurate and how reliable the data is that an AI model is using to give you advice. You can think of it like a warning system for bad information.
And here it is. This might be the most damning piece of evidence of all. The average Danger Index score for the top AI models was 42.8. And as you can see on this chart, anything over 40 is considered high risk. The most popular AI financial tools people were using were operating deep in the danger zone.
So, okay, after uncovering all these warning signs, from the hype bubble to the faulty bots, what are you supposed to do? What's the one thing that can actually protect your investments from a future like this?
Well, the answer is actually surprisingly simple. Look, AI is a fantastic tool. It can be a compass, it can be a guide, but it can't be the pilot. Your own mind, your ability to actually analyze things, your research, that is your best defense. That knowledge you build is the one asset that can never, ever be stolen from you.
Ultimately, it really just comes down to this.
Are you going to hand over control of your hard-earned future to some algorithm? An algorithm that, as we've just seen, could be operating in a high-risk danger zone.
And that leaves us with one final question that you really need to consider. Take a hard look at your own strategy. After everything we've just uncovered, you have to ask yourself, is my portfolio built on solid ground, on reality, or is it built on an AI-fueled dream?